Good afternoon, ladies and gentlemen. My name is Robert Rayburn, and I am joined by our analyst here, Tim Devlin. And I want to welcome everyone to a new month. It is April 1st, and we could not be more excited to put March behind us. It was a rough month. Every now and then, while we've been able to outperform over time, we're going to have some choppy months, and March was that month to be certain. But the good news is a couple days ago, for those of you who follow us on Twitter, will see that we did send out the all clear signal going forward. Now, what does that mean, ladies and gentlemen? Does that mean we're never going to have another down day here over the next 30 days or over the next week or 2 weeks? Of course not. What it does mean, though, is that we've had so many negative catalysts over the last 30 to 40 days, whether that was a hedge fund blowing up, quad witching in the options market, or the huge rotation that we saw from quality stocks to junk stocks as precipitated by vaccinations and interest rate increases. So many things thrown at the market here over the last month that just getting past that March period is a positive catalyst. The second big thing, and we're going to go over the stats today, but when we've had similar drawdown periods in the past, those investors that have either stayed disciplined or put money to work in our strategies during those drawdown periods have experienced the best forward return, 12-month forward returns of any client experience. And so we're going to go through those numbers today and why we are so excited about April, May, and June. And so we're going to go through all of that today. Lastly, we're going to go through some of the short-term trading conditions. That's another big factor to what's driving that all clear signal. We don't go through the minutia of the trading factors that we look at that much on our weekly updates, but I did want to go through that today with everyone that's watching the video today. So I'm going to go ahead and share my screen here. And the thing before we get started, one thing that I wanted to lead off with was some of the very attractive trading conditions we have seen play out here at the end of March and the beginning of April. Now, this is very nuanced. For those of you who do not invest for a living, you may say, well, who cares that the last day of March was positive and that the last day or the first day of April was positive? Statistically speaking, though, it's a very big deal. April is seasonally one of the strongest months out of the year. Now, what we see is that when at all instances, April tends to have around a 1.3% return rate from April 2nd to the end of the month. So not even including the first day of April, which we've already experienced. Now, when we see all instances from April 2nd to July 2nd, so really here over the next 3 months, we've had historical returns around 2.7%. Now, when you don't get positive returns on March 31st and April 1st back to back, those returns drop off a little bit from now toward the beginning of July. But here's the interesting thing, ladies and gentlemen, when you do get positive trading days on March 31st and April 1st back to back during a seasonally strong period such as April, those monthly returns jump from 1.3% to 2.4%, and those 3-month returns jump from 2.7% to 3.7%. So that takes your win ratio all the way from 67% to 70% and from 70% to 74%. So again, it is already a seasonally strong period for the stock market, the month of April, that is. But when you get that strong back-to-back finish to March and beginning to April, that win ratio does go up just a little bit more. A little bit nuanced, but something we want to pay attention to. The other big thing is, for those of you who have been invested in our strategies will notice the last 2 days have been pretty good for us. Now, the fact that we were able to outperform on March 31st through a period of what's called window dressing. So kind of peering into the shadows of Wall Street a little bit, what does that mean? Typically speaking, the last day of the quarter and the last day of the month, portfolio managers like to do something that's called window dressing. They want to buy the stocks that did the best from the previous quarter to show clients that they're in those names. That's manipulative. We know that, right? But why do they do that? Because clients will look at those stocks and say, yeah, the performance wasn't great, but wow, they own those stocks now that have done well over the last month. That means I'm set up for success going forward. That tends to exacerbate stock price declines for the losers and stock price increases for the winners in the last day of the month. But the fact that people were already starting to buy those secular growth stocks, those quality growth stocks that have been hurt over the last 30 days, I think speaks to a level of confidence that we're starting to see that violent rotation away from quality into junk starting to subside, so that we really like to see that action. Excuse me. The other thing here is the VIX chart on the right. When we look at the VIX chart, in other words, that demand for portfolio protection is now at the lowest level since pre-pandemic. This is a structural measure of confidence. VIX has traded from 10 to 17 in that band for most of the period from 2015 to 2018. Outside of brief periods in the late 2018, and then of course the pandemic where we shot up above that. So the fact that we're returning to that normalcy is a very big deal, and I think a positive catalyst over the next 3 to 6 months for the stock market.
Now, Rob, I think it's interesting when you talk about this window dressing concept.
Yeah,
Because one of the things you often talk to me about is so many times in this industry, portfolio managers will change up their strategy for the marketing message, or
absolutely.
won't stick to whatever their strategy that made them great before is. Can you kind of speak to that a little bit? Because I think that's a big distinction from what goes on in a lot of different funds in the industry versus what we do.
Yeah, no, that's a great point, Tim. So window dressing, at the end of the day, what portfolio managers like to do, Tim, is they like to show the winners in their portfolio. And that is to try and stem clients away from leaving their strategy if they underperformed over the last quarter, over the last year, over the last 2 years, etc. That's exactly what causes the underperformance, right? Because in many cases, managers are chasing performance. They're not skating to where the puck is going. They're just chasing the puck around the skating rink. For us, we try to blind ourselves from that noise and that manipulation. What we essentially want to say is, what are the types of companies that we want to invest in that over time, we have a high level of confidence will lead to structural outperformance versus what the market can provide over a 1 to 3 and 5 year time period. We know we're not going to win every inning of the baseball game. Our goal is to win the baseball game. So if we don't win the second inning, that's okay. We don't care. Our goal is to win an accumulation of those 9 innings, right? And if sometimes that means that we're not, placing a certain hitter in the cleanup spot that shouldn't be there, that's fine, right? We want to stick with best of breed companies that are going from good to great. And if we look at best of breed companies in the past, so these are not even companies that we own, such as Amazon and Facebook and Google and Netflix and etc. Those stocks have had huge gains over the last 15 years. Have they had periods where they've underperformed the market and where they've gone down in price? Of course, right? Apple's gone down 20% so many times I can't even keep count. But that's noise. It doesn't matter. You want to pay attention to the fundamentals. Weigh those fundamentals versus what's available in the market to invest in. And that's what should drive trading activity. And that's why we send out these weekly updates, because we are going to have weeks. We are going to have months where we underperform. But the goal is to outperform over time, upward and to the right. If we stay disciplined, we stay focused, and we stay true to our philosophy, I think that over a 6 to 12 month time period, clients are going to be very happy with the results. But that's a great point, Tim. Now, broader picture, longer picture, not even relating to our strategies, ladies and gentlemen, we want to remind people, as we do every week, we are in the middle innings of a secular bull market. What does that mean? That means whether you invested in our strategies, whether you're in Oppenheimer, Vanguard, doesn't matter. Any equity-based strategy, stock-based strategy, you need to have patience during drawdowns when we're in a secular bull market, because patience is your friend. Patience is what's going to pay and help you accumulate wealth over time, because time is on your side when you're in a secular bull market. What has happened in previous secular bull markets? On average, around 1,300% rate of return from the bottom to the end of that 20-year secular bull run, whether that was from 1942 to 1968, as we see here on the top left chart, or from 1982 to 2000, where most of our clients are more familiar with, which delivered a 1,389% rate of return. Right now, we're at a 481% rate of return. If we look through time and we believe that this secular bull market will be consistent with prior secular bull markets, we have a long way to go, ladies and gentlemen. That's why it's so important to be patient during these pullbacks in the market. And if we do our job as active managers and are able to focus on best of breed companies that are going to win this bull market, not stay with the bull market, not lose the bull market, but win the bull market, I believe we'll do better than these numbers. So that's something that's so important, and one reason we need to be disciplined. Real quick here on performance. You know, a few days ago, this looked a lot worse. We've had a nice comeback here, down only around 7% now. And the only reason why I say only down around 7%, ladies and gentlemen, is we have to remember what the 1-year performance number is. We're up 123.03%, top in the country when we compare ourselves to other growth strategies in our category on Morningstar, top in the country at 123% rate of return. Sometimes our stocks are going to pull back and they're going to need a breather. And sometimes those stocks that didn't participate in that outperformance are going to play a little bit of catch up. And that's what you see here in that year-to-date number, which is only really 3 months into the year, ladies and gentlemen. I will bet a huge sum of money with my own dollars that we will catch up and surpass the S&P 500 here over a very short-term time period. So very confident in that. When we look at that inception number, up 202% over since January 1st, 2017 versus 79.55% for the S&P 500. So over time, we've been able to deliver 122% rate of return outperformance versus the S&P 500 after fees. And we can see that. And this is what we were talking about, Tim, over time. Over time, you want to make sure that your portfolio manager, your investment strategy is delivering investment value upward and to the right. So yeah, year to date, we've underperformed, but look at our outperformance over 1 year. Over 1 year, we've outperformed the S&P 500 by 60%. How about over 3 years? That moves upward to the right to 89%, then 114%, then 122.75%. Why? Because over the very, very short term, the market is a noise machine. Stock prices go up, they go down. Could be all for quad witching and interest rate increases and what's going on overseas in Europe and China. That has nothing to do with the company itself and how many widgets they're selling. But what is important over time is to pay attention to how many widgets the company is selling over time. That's what ultimately drives the stock price over the long term. Now, Tim, do you want to go through this chart for our viewers? Because I think it's the most important chart that we can send out.
Yeah, absolutely. So, you know, we've been talking about this the past couple of weeks that when we look at our clients in the past, the best forward returns have all been received in times where we've been in a drawdown, right? Where we've had, you know, 10%, you can see negative 26%. What we want to do from these drawdowns is look what happened 1 year forward for our strategy, and then what that outperformance versus the S&P 500 is. So You can see this light green line is anytime we hit a 10% correction. This light yellow line is anytime we've had a negative 20% correction. And you can see these circled drawdowns here. We can see the first one, negative 9.81% drawdown. 1 year forward, we had a 9.94% return versus the S&P 500, which had 7.04. But we can see in these deep drawdowns, especially the next one here, negative 26.56 for the opportunity. 1 year forward, our clients were up 53.38% versus the S&P up 39.89%. So we can see that forward year return is often greatest during times of distress, right?
That's right. You want to be opportunistic, ladies and gentlemen. When there's blood on the streets, that is a time to be disciplined if you're already invested, or if you got money to work, to start putting that money to work. Buy some of these highly valuable companies that are deeply on discount. That's how you build wealth. Everything else is noise, right? So when we look at this, not only, I mean, let's focus on these deep drawdown periods. This was December of 2018, right? During Christmas, the worst possible time for the market to go down. And people were scared. And that's understandable. No one likes to see their account values go down, especially when they're spending money on Christmas gifts. But those 1 year forward returns of 53.38% changed people's lives. And on top of that, we were at a new high. And I think that's the key, ladies and gentlemen. Every single time we've had a drawdown, not only have our 12-month forward returns been extremely attractive, but we've hit new highs. We're not trading in a sideways pattern. It's not a boom bust scenario. We are upward and to the right, as we've seen in these charts here, upward and to the right, upward and to the right. Historical cumulative performances continue to make new highs. If we look at even these minor drawdowns in 2019, a 12% drawdown, a 1 year forward return of 101% versus 19 for the S&P 500. And again, a 36% drawdown to be rewarded with 154% rate of return after fees for those investors last year at this time. This time around, we've had a 21% drawdown. Now we've bounced significantly off those levels already. We're up 6% over the last couple of days. What do you think will happen over the next 12 months? Who knows? But if we look statistically speaking we statistically look at what's happened in the past, I would be willing to bet we're going to be a lot higher than we are today. I can't guarantee that, of course, right? But if I look at the market conditions, I look at the fundamentals of these companies, and I look at where their prices have gone over the last 30 days, now is such an amazing time to buy these market leaders. And so that's really at the end of the day, what's driving a lot of our optimism that you can see is like really pouring out. I just get really excited during these short-term drawdown periods in the market. And again here, ladies and gentlemen, this is just a couple of charts that we tweeted out earlier in the week, but after every 7.5% sell-off we've seen in our strategies, the 12-month forward returns have been positive 100% of the time. Now, does that guarantee performance going forward? Absolutely not. We're just saying in history, this is what has tended to play out. Same thing on the relative performance. After every 7.5% sell-off, our 12-month forward excess return versus the S&P 500 has been positive 98.4% of the time. So this chart on the left says, can you make money by investing in even shallow drawdown periods or deeper? Answer is yes. The chart on the right is saying, is your portfolio manager earning their fees? And the answer is yes, historically speaking. Now, the next few charts here, we're going to talk about the story of March, right? It's important. When prices come down, we want to know what went wrong so that we can prepare for the recovery in a proper way. So we avoid, right? We avoid that mistake that Tim was talking about earlier of window dressing and chasing returns. Let the puck come to us, right? Let's stay focused, but we have to know what went wrong in order to properly positioned for what will work going forward. The sell-off in our strategy, or the rotation from quality to junk, began in mid-February, and that was right when vaccinations started to tick upward. And we knew that was happening, right? If you look at our weekly updates in February, we talk about, hey, we are expecting this big surge up in vaccinations. What we didn't necessarily see was the big surge in interest rates that were going to happen as well. So the combination of the two caused this huge rotation from what the market has labeled work from home. We vehemently disagree with that characterization. We prefer to call it secular digitization of the US and global economy, into these epicenter stocks. So stocks that have been most heavily impacted in a negative way by the drawdowns. So we saw this big rotation. But notice what's happening here. These epicenter stocks are not making new highs. And that's because if we look at the stock prices of a lot of these epicenter stocks, they're trading very close to those levels that they were last February. And why is that important? That is important because the growth prospects for these stocks are not structurally changing over the long term, even in a more normalized environment. Yeah, they're not going to zero, they're not going bankrupt, and that deserves for those stocks to be repriced as such. But they're not suddenly going to become secular growth stocks either. And so after your normalization period, you're likely going to have a little bit of a hangover period. And we'll talk about that here in a little bit.
Yeah, and Rob, what I think is interesting about that chart on the previous slide there is whenever we see something like the increase in vaccinations, you get this big divergence or kind of a big move. And then people start to reassess, what they own, what happened. And you see kind of like that leveling off you just talked about, right? That initial move is where a lot of the noise happens. And then people go back and say, hey, these are good stocks or these aren't good stocks.
Yeah, and I'll take that a step further because at the end of the day, there's going to be some of these stocks that are in the epicenter group that are the real deal. But there's going to be 80% of them that are flashes in the pan. And that's what we want to avoid chasing that, right? There's a lot of companies that have piled on a whole ton of debt to survive. We need to avoid those because any single time there's a hiccup in the economy, those are going to get annihilated and killed because they have a lot of leverage. Leverage kills. And we saw that last week with a family office hedge fund that blew up by using a lot of leverage. Leverage is dangerous, ladies and gentlemen. It can be used responsibly, but it's dangerous when abused. And a lot of companies, in order to survive over the last 12 months, have piled on a ton of leverage. We believe in clean balance sheets. We invest in simple stories that are positioned for long-term secular growth, that are good getting better, and have low levels of debt. Now, that's going to mean sometimes that we underperform. And that's what this chart here is all about. So this chart here, what it shows is the relative performance of weak balance sheet companies versus strong balance sheet companies. What did we see here in the last couple of months? Those weak balance sheet companies have massively outperformed high quality balance sheet companies. That's okay with us. We're okay with avoiding junk. You know why? Because yeah, we might go down 10% over a very short period of time, 15%, 20%. Those companies though are going to come back because they're high quality, clean companies. These companies, on the other hand, are going to have vicious rallies to the upside in a very short period of time. But when the weather turns south, these companies are going to get killed. They're going to get beheaded. And we want to avoid that return of capital risk for our clients. That's important. That's where the discipline comes into our investment process. The other big thing is, in terms of what happened in March, is this big rebalance that was taking place. We talked a little bit about this last week, but I want to get into it a little bit more. So a lot of the market is driven by momentum, and we have huge momentum ETFs that are driven by relative performance of certain sectors over very short periods of time. And what's happened is hedge funds are now looking forward to what that May 31st rebalance is going to be on a lot of these momentum-based ETFs. And what they see is that we're going into an implied rebalance away from technology and consumer discretionary and healthcare to financials, discretionary, industrials. That's what drove a lot of that short-term selling in March. Remember what we said though, buy the rumor, sell the news, sell the rumor, buy the news. As we get closer to this, you're going to see is that a lot of those short-term trades are unwound and we get back to focusing on the long term. So very important point here, ladies and gentlemen, is that a lot of this was buying into or selling into this rumor or fear of rebalancing. Once we get past March, you start to see that unravel a little bit and you get back to the longer term picture. Now, Tim, you were speaking a little bit about this hangover trade, right? So we get that initial pop, right? Companies aren't going bankrupt. The banks right past 2009 aren't going bankrupt. So Citigroup goes from $1 to $3, 300% rate of return. Looks pretty good. You look like a hero. But then guess what? Banks were dead money for the next 10 years. Epicenter stocks, same thing. They're going to survive. They're not going bankrupt. Big rally. But guess what? All that debt leads to a hangover. What happens when we have a lot of debt, Tim? What happens to consumers when they have a lot of debt? What can they not do a whole lot of over the next few years as they're working off that debt?
Yeah, they can't save, they can't invest, they can't grow their assets, right?
At a company level, what that means is that a company can't invest in innovation. A company can't invest in new products to help them grow above their competition. That's important. We want to avoid these companies over a long period of time. Now, over the very short term, ladies and gentlemen, I wanted to go over some of these trading conditions because they're important. It's what's driven a lot of the short-term selling in March and what will drive the recovery in April and May. Now, in the NASDAQ, we are a little bit more impacted by the action in the NASDAQ because of our overweight position in technology and software, cloud stocks in general. So we want to look at the trading conditions in the NASDAQ. What we see here was we had a big low put in, really call it the early innings of March. One thing we always say about stock market corrections or investment style corrections is that you start with a bang, this big selling, high volume, lots of fear. You see the fear in people's eyes, and then you get a counter trend rally. And that's what we had. We had this big counter trend rally, and then we tried to test the lows. And over the last week, what we've seen is those lows have been tested and they've been met. We made a higher low. Very important point, ladies and gentlemen. We made a higher low. And we started to break out from this resistance point. This is what sort of this rising wedge as we were talking about in the NASDAQ. Combine that with the end of March, beginning of April trading conditions. This is a very positive sign. Green shoots, as we call them. Then what we like to do is look at what are the riskiest areas of the market, right? What are the areas of the market that represent pure risk appetite, right? No one is going to say, hey, a pension fund is buying into this for income planning or anything like that. Pure risk. Bitcoin. So when we look at Bitcoin, the trading action there is we've had a series of higher lows in Bitcoin, in cryptocurrencies in general. What we've also seen is a series of higher highs. Also an important point. Big sell-off in February, along with the rest of the growth market within the stock market. We had a big, nice recovery, then a retest, higher low. Where else did we see a higher low? The NASDAQ, right? Higher low with the NASDAQ, higher low with Bitcoin, and a big inflection point higher. Now, within the cryptocurrency space, everyone knows that's been following us. We are massive fans of Ethereum. So let's look at what Ethereum has done over the same period of time. Higher low, but then this is even more bullish, ladies and gentlemen. A huge cup and handle formation that has formed with Ethereum, testing the new highs, testing previous highs in February and trying to break out to new highs. So two areas that we said, well, now let's combine it with the so-called work at home trade. Peloton's a name that we've owned. has not done well over the last, really the last month. If we see that big sell-off, low established in early March, along with the NASDAQ, small retest, then traded in a channel, then made a higher low before breaking higher over the last few days. Now, we can't call this a breakout yet, but if everything follows in that narrative, these types of stocks are positioned to do well over the next couple of months. We could be wrong, but when we look at the balance of evidence, and that's something we always have to make sure we're doing, we follow the balance of evidence. Sometimes the balance of evidence could be wrong, but the balance of evidence over time, greater than 50% of the time, tends to lead us in the right direction. So the balance of evidence, when we look at the NASDAQ, those higher lows breakout, Bitcoin, series of higher lows breakout. We look at Peloton and other stocks like Peloton, right? Not just ones we own, others we don't own. Higher lows trying to break out here as we get into April. Again, Ethereum, two big pivot lows here, massive cup and handle formation, breaking out upward and to the right on big volume. That gives us confidence. And then when we look at the fact that inflation is just running rampant in headlines, when inflation's on when any issue, whether it's bullish or bearish, is in the front page, please, ladies and gentlemen, start to take the opposite side of the trade, because when it's on the front page, everyone in your neighbor is already in. Inflation, everyone knows about it, ladies and gentlemen. Let me just tell you that the March number is going to look hot. In other words, come in above. April is going to look hot, come in above. We just spent the last 2 months pricing that in. That is a buy the news event. You sell the rumor, you buy the news. Buy the rumor, sell the news. In this case, it's you are, what is it? You are selling the rumor, buying the news. So just a very important point. Very interesting point too, by the way, Tim, is that on the news of this $2 to $4 trillion infrastructure package, interest rates went down today. Very curious, given all the spending. Why? Because that's the last piece, right? We all knew it was coming. We had the stimulus package and then the infrastructure package, part 1, part 2 coming in, another 2 trillion. That's it. We're done. No more. Interest rates coming back in, right? A lot of international investors that are dealing with negative interest rates. Wow, 1.7, that's huge. So you're starting to see that cap out. A very good setup for the period going forward. So ladies and gentlemen, to wrap everything up as we get into the Easter weekend, the all clear signal really implies that when we look at the nature of the drawdown we've had over the last month, historically speaking, those drawdown periods have led to very, very attractive 12-month forward returns. So we want to be opportunistic in this environment. It's so important. So the big message, we've successfully tested the lows from early March. If you remember back in mid-March, we said we're having a nice rally, but we wouldn't be surprised to see a retest of the lows. We tested the lows, we retested and inflected higher. Very good symptom for the areas of the market that we are invested in. There's also signs that fund flows are returning to those secular growth firms that are our bread and butter. And then remember, investing and stay disciplined during drawdown periods is what leads to long-term investment success. So thank you, ladies and gentlemen. We know that March was not the best month ever, but we're going to have months like that. That's what ultimately leads to outperformance. But we are just so impressed by the discipline and how much our clients are learning along the way. It's incredible. And so, our lines, as everyone knows, are completely open. Please reach out to your advisor. They're there, they're waiting, they're reaching out to you to really, say, how can we take advantage of this market environment? Also, our lines are open. Please feel free to reach out to us. Whether it's here at the office, on my cell phone, our doors are completely open. Thank you again. Have an incredibly happy Easter for those that celebrate. Otherwise, have a fantastic long weekend. And thank you again, Tim, another great weekly update. Love working with you here. So hopefully
Yeah.
you'll keep coming back.
Yeah, thank you. And you enjoy your Easter weekend as well.
All right. Take care, everyone. Thank you.